If they raise rates and tighten monetary policy, which would also mean going back to quantitative tightening, if they were to raise rates by a degree that would actually be sufficient to rein in this inflation that they let loose, the rate would be so high that our debt-laden economy would completely implode, and we'd have a much worse financial crisis than the one we had in 2008. I mean, it wouldn't even be close to how bad it would be. And the government couldn't do anything to bail anybody out because the Fed would be hiking rates, not cutting them. So for that reason, I don't believe the Fed will do what Paul Volcker did in 1980, because from the Fed's perspective, the cure will be worse than the disease. So the disease of high inflation is going to get worse.
The Federal Reserve faces an impossible dilemma where raising interest rates enough to combat runaway inflation would inevitably trigger a debt-fueled economic implosion. Unlike the 1980s, the current levels of national and consumer debt make a Volcker-style intervention a mathematical impossibility, as the resulting financial crisis would dwarf the 2008 collapse. Peter Schiff, a renowned economist and global strategist, argues that the cure, aggressive monetary tightening, has become more dangerous to the system than the disease of inflation itself. He points out that with the U.S. national debt recently surging past $39 trillion, any significant hike in borrowing costs would lead to a catastrophic sovereign debt crisis. Because the Fed is trapped between devaluing the currency and bankrupting the nation, Schiff believes they will choose continued inflation, effectively letting the cost of living soar rather than allowing a total systemic meltdown. This trajectory suggests that the government has lost its ability to bail out the economy, leaving hard assets as the only remaining shield against a dying fiat system. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When you say stagflation, most people think of slow growth and high inflation. I think it's going to be a recession with high inflation. So like almost like a inflationary depression. Because I don't think stagflation does it justice, because I think it's going to be something much worse again than the 1970s. And part of the reason that it doesn't look as bad now as it did back then is because the government was more honest about the inflation rate and the unemployment rate in the 70s than they are today, because the methodology that we used to calculate unemployment and inflation were very different. And so when Powell tries to contrast the current unemployment rate with the unemployment rate during the 1970s, it's apples to oranges. In fact, it's not even apples to oranges. It's apples, to bricks. They're not even similar because the methodology is so different. So if we kept track of unemployment and inflation, because it's the same thing, the way we did in the 70s, you would have to double pretty much both the unemployment rate and the inflation rate to get a number that would represent what it would have been had we measured them like we did in the 70s. So when you make that adjustment, the inflation and the unemployment rate that we have now is not that much lower. Our unemployment is not that much lower and inflation not much lower than it was in the 70s. And it's about to get a lot higher. That's the thing. Unemployment is going to spike and inflation is going to spike even more. If they raise rates and tighten monetary policy, which would also mean going back to quantitative tightening, if they were to raise rates by a degree that would actually be sufficient to rein in this inflation that they let loose, the rate would be so high that our debt-laden economy would completely implode, and we'd have a much worse financial crisis than the one we had in 2008. I mean, it wouldn't even be close to how bad it would be. And the government couldn't do anything to bail anybody out because the Fed would be hiking rates, not cutting them. So for that reason, I don't believe the Fed will do what Paul Volcker did in 1980, because from the Fed's perspective, the cure will be worse than the disease. So the disease of high inflation is going to get worse. And so if people thought inflation was bad when Biden was president, wait till they see how much worse it's going to be during the balance of the Trump term. And then when Trump loses in 2028 and we get a Democrat in 2029, it'll be even worse. So inflation is going to continue to accelerate. in the foreseeable future. As far as the eye can see, inflation is going to go into the double digits, and who knows, it may even go into the triple digits. But it's going to become a huge problem because the Fed can't do anything about it politically. Now, they could if they were willing to, take the hit. Donald Trump talks about how he thinks we should have some short-term pain for long-term gain when it comes to paying high gas prices to win a war against Iran. Well, we should do the same thing in the economy. We should have to take short-term pain, massive cuts to government spending, eliminations of agencies and departments, and we should have to take a recession, a severe recession, with a big drop in the stock market, a big drop in the real estate market. So a lot of wealth wiped out, a lot of companies going bankrupt, a lot of debt going into default. We have to take that serious economic downturn. That's the short-term pain we need, to get the long-term gain that unfortunately we're not going to get.
Because we won't take that short term.
We're not going to get that short-term pain. Mm-hmm. We're just going to get much more excruciating long-term pain. Yeah, but we're going to get inflation. So instead of the government reducing our benefits, the government will reduce the value of our benefits by creating inflation. So instead of defaulting on its bonds, it pays its bonds in money that doesn't buy very much. Instead of cutting Social Security benefits, the value of your benefits gets cut because you can't buy very much with your Social Security checks. So, but the way the government is going about it, because it's politically more palatable, is actually worse economically. So all the people who are going to suffer from inflation, if we just asked them or told them they were going to get less money, they would actually be better off because the money they got would buy more. Instead, they're going to get all their money, but they're not going to be able to buy very much with it. It would be worse than 2008 if the Fed did the right thing. Mm-hmm. But because it won't do the right thing, because it knows that doing so would create a worse financial crisis than 2008, it won't. And so what's going to happen is not going to look like 2008. It's going to be a different type of crisis. I think it's going to be a U.S. dollar crisis, a sovereign debt crisis, and you're going to have very high inflation. Mm-hmm. And so I think the real losses that average Americans and investors are going to suffer as a result are going to be greater than the losses that were suffered in 08, 09. And in fact, if you held on, even if, the stock market got cut in half and you didn't sell anything and you held on, the government bailouts bailed you out. The market came up and made new highs. But this time people are going to get wiped out, and the bailouts or the attempted bailouts will just wipe out what's left. So it's, the government's going to make it worse this time for investors, and all Americans are going to suffer the consequences of these misguided policies.
The current economic trajectory suggests an impending inflationary depression far more severe than the stagflation of the 1970s. Modern reporting often masks this reality because today's methodologies for calculating unemployment and inflation are fundamentally different from those used decades ago. If we applied 1970s metrics to current data, both rates would likely double, revealing a much more precarious situation. The Federal Reserve remains trapped. Raising interest rates to levels sufficient to curb inflation would cause a debt-saturated economy to implode, triggering a financial crisis far exceeding the 2008 collapse. Instead of facing the necessary short-term pain of massive spending cuts and defaults, the system is leaning toward long-term currency debasement. This sovereign debt crisis will manifest as a relentless loss of purchasing power, where nominal Social Security benefits and bond payments are maintained, but fail to cover basic living costs. As the U.S. dollar faces a fundamental crisis of confidence, the resulting wealth destruction for average Americans will likely be permanent, as future bailouts will only accelerate the inflationary spiral. Let's get back to the interview.
Gold got to $5,500 and change earlier in the year, and after today's almost $200 sell-off, we're back down below 5,000. We're 48,817. And this sell-off was mostly the result of the hotter than expected PPI numbers. And then gold sold off a bit more after the Powell press conference, where Powell acknowledged that at the last FOMC meeting, they discussed the possibility of a rate hike. Even though nobody was recommending one, the fact that they even discussed raising rates was problematic. Now, of course, they should have hiked rates. But gold went down because investors are now pushing back the date when they expect the next rate cut. But I don't think that is what's important here. It's not about when the Fed cuts rates. Doesn't matter if the Fed cuts rates. What matters is that they're not hiking rates, and they should be hiking rates. See, investors are focused on nominal interest rates. They're saying, oh, the nominal rates, the Fed funds rate is going to stay at 3.25. It's not going to go down to 3 or 2.75. So they're selling gold. What matters is the inflation rate. If the inflation rate doubles from 3 to 6, and even if the Fed hiked rates to 4%, which they're probably not going to do, but even if they did that, but inflation went from 3 to 6, real interest rates would decline from a positive 0.5% to a minus 2%. So a negative 2% real yield, that is very bullish for gold. That is very bearish for the dollar. The markets still don't get what's happening. The Fed is way behind the curve. There's a huge inflation problem, but the Fed is powerless to do anything about it, because if it does something about it, everything crashes. I mean, look at Fannie and Freddie Mae stock today. The GSEs were down. They're down about 65% now since the big runoff when Trump, a big run up, because Trump was talking about, privatizing them, releasing them from conservatorship, which was a commitment that he made to a lot of his donors who were big shareholders in Fannie and Freddie. I mean, the best thing he could do for the country is to get rid of them completely. The worst thing he can do is what he was promising his donors he would do. But if you look at what's happened now, the share price is collapsing. And I think it's not just because it doesn't look like Trump is going to be able to follow through with these commitments, but look what's happening to the housing market. Mortgage applications just collapsed. Refis just collapsed because mortgage rates are now rising along with other interest rates. And houses are the most overpriced they've ever been, more so than they were at their peak in 2005. We need at least a 30% reduction, if not more, 30 to 40% decline in home prices, given where mortgage rates are now. But if mortgage rates move up, which I think is more likely, who knows how much bigger the decline may need before houses are affordable again. But home prices are going to be determined by what the buyers can pay, not what the sellers are hoping to get, because that doesn't matter. And during this next downturn, with a big increase in unemployment and a recession, a lot of homes are going to get sold, and they're going to get sold at much, much lower prices. And it's going to reset all the comps, and you're going to wipe out home equity for millions of people. And what does that mean? That means a lot of those people default on their mortgages. And that means big losses for the GSEs. And that's one of the reasons I think they're starting to go down, is people are starting to get worried about forgetting about privatizing them. They're about to need another government bailout. Of course, they're owned by the government right now, so the government would be bailing itself out. But the point is, who would want to buy Fannie and Freddie when all you're doing is buying a bunch of liability? Ironically, and maybe not so ironically, if you're familiar with these trading patterns, but the war has helped the dollar. The dollar has rallied a bit on the war, and that's typical as a safe haven move. The war has helped to lift interest rates, and that has also acted as a short-term boost to the dollar. But I think the dollar's rally is not that big compared to rallies of the past under circumstances like this. And I think that shows you that times are changing and the dollar is not seen as favorably as it was in past military conflicts. And I think as time goes by and the war drags on, I think it's ultimately going to be a negative for the dollar because it's going to weaken the economy. It's going to lead to bigger budget deficits, more inflation. All this is dollar negative. And, it's just another thing that's going to upset the world, something that the United States has caused, because the world is going to be dealing with higher energy prices, higher food prices, the longer this war goes on. And, that they can just blame that on Trump. Meanwhile, Trump has already pissed everybody off with the tariffs, even though the tariffs are paid by Americans, contrary to the claims of Trump and his administration. Americans pay the tariffs, but to the extent that imported goods are a lot more expensive because we have to pay the tariffs in order to import them. That is, bad news for a lot of foreign companies that now sell fewer goods to America. They have to find other customers, and maybe they can't pay as much as we did. And so, yes, it is, a negative for some companies. And, so we pissed off a lot of these companies. These are trading relationships that have been going on. And, I think we've also antagonized people with our threats. Like, Trump was threatening to invade Greenland. I mean, what the hell did Greenland do? Right? Greenland wasn't a threat to anybody. But Donald Trump decided that we needed Greenland. Strategically, we needed to own that real estate. And he said, if we can't get a deal, we're going to send our troops in. We're going to take it by force. Now, he never did that. I think he backed away. But the fact that he even contemplated it out loud, I think, is a big negative, because it gets people to thinking, maybe they'll do it next time. So I think we've, we're losing a lot of our, credibility. I think a lot of our allies are not as aligned with us. And I think we're driving our enemies closer together. And I think we're even driving our allies to have greater ties with our enemies. I mean, to the extent that we perceive China and Russia as enemies, I think they're making a lot of inroads. In fact, if you look at Chinese trade is growing with Canada, it's growing in South America. Even as it's declining with us, China is now doing more trade with everybody else.
The recent gold sell-off below the $5,000 level is a classic case of market myopia, where investors are fixated on nominal interest rates while ignoring the explosive reality of real negative yields. Although hotter PPI data and hawkish FOMC rhetoric have temporarily dampened sentiment, the Federal Reserve remains fundamentally powerless. Hiking rates to a level that would actually stifle 6% inflation would immediately collapse the debt-saturated U.S. economy. We are already seeing the first tremors in the housing market, where collapsing mortgage applications and plummeting GSE share prices indicate that a 30% to 40% reset in home values is likely inevitable. As unemployment spikes and the Trump tariffs further increase costs for American consumers, the illusion of a strong dollar safe haven will evaporate. The shift is already visible as global trade pivots toward China and Russia, leaving the U.S. increasingly isolated from its former allies. Ultimately, the Fed cannot hike us out of this crisis without destroying the system, making physical gold the only logical refuge as the dollar's credibility continues to erode on the global stage. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.